Okay, so you want to own an apartment building. Buy a property, fill it with tenants, collect rent every month, and watch the cash roll in. People always need a place to live. Leases renew. The building sits there whether the economy is booming or weak. It sounds safer than a restaurant, simpler than a factory, and easier to understand than a bank. That is the dream. The problem is what happens between the dream and the reality. An apartment building is not just a pile of units with rent checks attached. It is a leveraged operating business wrapped inside a piece of real estate. It sells housing, yes, but it also sells location, safety, maintenance, convenience, and stability. At the same time, it consumes debt service, repairs, insurance, taxes, payroll, utilities, turnover costs, regulation, and capital expenditure. On paper, it can look like passive income. In practice, it often behaves like a machine that works beautifully until one or two variables move against you. That is why this business attracts everyone from first-time landlords to pension funds, private equity firms, insurance companies, family offices, and giant real estate investment trusts. The visible asset is simple. The economic system underneath it is not. The ownership fantasy usually begins with a basic idea. A tenant pays rent every month. Multiply that by 20 units, 80 units, or 300 units, and the income starts to look enormous. Maybe rents rise a little each year. Maybe you renovate a few units and charge more. Maybe the neighborhood improves and the building becomes more valuable while tenants cover most of the mortgage. It sounds almost unfairly good. Then, the first complication appears before closing debt. You usually do not buy the building with cash. Even wealthy owners rarely want to tie up all their own money in one asset. So the business starts with financing. A lender underwrites the deal based on purchase price, net operating income, property condition, local rents, vacancy, taxes, insurance, and your plan for the building. What matters immediately is not just whether the property looks attractive. What matters is whether the income can support the debt. That distinction changes everything. In apartment ownership, the building value often flows from income rather than the other way around. A rough shorthand used throughout commercial real estate is the capitalization rate, or cap rate. In plain language, it is the unlevered return the property produces based on its current net operating income. If a building generates $1 million a year of net operating income and trades at a 5% cap rate, that implies a value around $20 million. The same building at a 7% cap rate would be worth much less. Small changes in rates can reshape value fast. That means apartment owners are not only making a bet on rents and occupancy, they're also making a bet on financing conditions, local supply, regulatory risk, maintenance needs, and the pricing environment for income-producing property. Before you even reach that point, there's the gatekeeping process. Unlike opening a small online store, apartment ownership sits inside a system of lenders, brokers, inspectors, title companies, insurers, municipalities, housing codes, fair housing rules, zoning laws, and often rent regulations. Money alone is not enough. The seller has to agree. The lender has to approve. Insurance has to be placed. The title must be clean. The city may require certificates, inspections, lead paint compliance, elevator permits, fire safety compliance, accessibility rules, and registration of rental units. In some markets, a future rent increase is constrained by law. In others, eviction timelines can stretch for months. The real business begins before the first tenant calls with a maintenance issue. Now consider the entry price. Suppose you want a modest 60-unit suburban apartment building in a decent market. The list price might be $10 million in one city, $15 million in another, and far higher in supply-constrained coastal markets. A larger institutional quality building can run into the tens or hundreds of millions. But the purchase price is only the headline number. Add due diligence, physical inspections, environmental reviews, legal work, appraisal fees, loan fees, rate lock costs, title insurance, survey costs, transfer taxes, and closing expenses. All land before the property starts working for you. If the plan involves renovations, you may also need fresh capital for unit upgrades, lobby improvements, roofs, parking lots, plumbing repairs, elevators, boilers, or HVAC systems. Then there is working capital. An apartment owner who closes with no cash cushion is not an investor. That is a future emergency. A realistic acquisition might look like this. Purchase price, $12 million. Closing and financing costs, perhaps $300,000 to $600,000. Initial repair and upgrade budget, $1 million. Operating reserves, another few hundred thousand. Suddenly, the all-in requirement is materially above the sticker price. Most owners solve that with a capital stack. The stack usually starts with equity and debt. Maybe the bank lends 65 to 75% of the cost, and the buyer contributes the rest. On a $12 million purchase, a 70% loan means $8.4 million of debt and $3.6 million of equity before closing costs and renovation reserves. Add those extra needs, and the actual equity check may climb closer to $5 million. The financing can be fixed rate or floating rate, short-term or long-term, recourse or non-recourse, interest only for a while, or fully amortizing from day one. Those details sound technical. They are really the skeleton of the business. Recourse means the lender may have claims against you beyond the property itself. Non-recourse limits that exposure, but often comes with stricter structure and carve-outs. Fixed-rate debt protects you from rate jumps, but can be more expensive upfront. Floating-rate debt may look attractive during easy money periods, then become brutal when rates rise. Interest-only payments improve short-term cash flow, yet they also delay the discipline of paying principal. Every financing choice changes the risk profile. Once the building is yours, the obvious revenue stream is rent. But apartment economics become clearer when you see the full revenue stack. Base rent is the first layer. That is what people think of immediately: monthly rent collected from occupied units. In a healthy market, it is the dominant income source. Yet strong operators usually build additional revenue around it. Parking can produce meaningful cash, especially in urban buildings with limited spaces. Storage lockers may be rented separately. Laundry rooms can contribute income. Pet fees and pet rent add another layer. Application fees, late fees where legally permitted, utility reimbursements, furnished unit premiums, package lockers, amenity fees, and short-term premiums on renovated units all expand the revenue system. In some properties, internet or cable partnerships create small but recurring income lines. A building with ground floor retail or rooftop telecom access may have still more sources. That matters because apartment ownership is rarely just a story of one rent figure multiplied by 12 months. The quality of the revenue also matters. Some income is contractual and recurring. Some depends on turnover. Some is politically exposed. Some can disappear if the market softens or regulators intervene. Base rent tends to be steadier than application fees. Parking may be resilient in one neighborhood and weak in another. Utility reimbursement only works if your leases and local rules allow it. A smart owner wants layered income, but also needs to know which parts are durable. Then the cost machine comes into view. The most dangerous misconception in apartment ownership is that the building mostly runs itself after tenants move in. Even a well-located property with stable occupancy carries a constant stream of expenses. Real estate taxes come first in many markets because they are both large and difficult to control. Insurance has become especially painful in recent years, with premium spikes in disaster-prone areas and tougher underwriting across the industry. Payroll may include a property manager leasing staff, maintenance technicians, cleaners, or security. Utilities hit owners when units or common areas are not fully separately metered. Repairs and maintenance never stop. Landscaping, trash removal, software, pest control, legal costs, marketing, make-ready expenses, and unit turnover keep draining cash even in ordinary years. Above all that sits capital expenditure. This is where many amateur owners confuse a building with a bond. A bond does not call at midnight because the boiler failed. A building does. Roofs wear out. Elevators need modernization. Pipes corrode. Parking lots crack. Exterior paint fades. Appliances die. Water intrusion creates hidden damage behind walls. A property can look profitable right up until the year when 3 or 4 deferred items arrive together. That is why professionals separate everyday operating expenses from major capital needs. The income statement may look healthy, while the building itself is quietly accumulating future bills. Now add debt service. Net operating income, or NOI, is what remains after operating expenses, but before debt service, income taxes, and capital structure decisions. It is one of the central figures in apartment economics because lenders, buyers, and sellers all watch it closely. Yet owners do not live on NOI. They live on cash flow after debt. This is the structural shift from real estate theory to ownership reality. A building can show attractive NOI and still produce disappointing cash flow if the debt is heavy or expensive. The opposite can also happen, for a while cheap financing can make a mediocre building appear healthier than it really is. In apartment ownership, leverage magnifies both intelligence and mistakes. That brings us to the central trap. The main trap in this business is simple to state and painful to experience. Apartment buildings are valued as stable income assets, so buyers often use debt to amplify returns. That works well when occupancy holds, rents rise, and capital remains available. The trouble begins when financing costs, capital expenditures, or regulation rise faster than rent growth. Suddenly, the same stability story turns into a squeeze. Tenants cannot absorb unlimited increases. The lender still wants payment. The roof still needs replacement. Taxes and insurance still arrive. Cash flow tightens from both sides. In other words, the building can be full and the owner can still feel poor. A normal year can hide that problem. A stressed year exposes it. Look at the bargaining power inside the system. Tenants obviously matter, but so do other stakeholders. Municipalities can reassess values and raise taxes. Insurers can reprice risk in one renewal cycle. Utility providers can raise costs. Contractors gain leverage during labor shortages. In rent-regulated markets, lawmakers influence pricing power directly. In soft rental markets, tenants gain power because moving incentives, concessions, and free month offers become necessary to keep occupancy up. The owner controls the property, but not the wider environment around it. The business becomes clearer when one variable changes. Imagine a 100-unit building with average monthly rent of $1,800. At full occupancy, gross potential rent is about $2.16 million a year. Assume economic occupancy after normal vacancy and bad debt of 95%, giving roughly $2.05 million of effective rental income. Add another $150,000 from parking, laundry, pet fees, and other sources. Total effective revenue reaches about $2.2 million. Now subtract operating expenses. Property taxes might run $260,000. Insurance, $120,000. Payroll and management, $320,000. Repairs and maintenance, $180,000. Utilities, $140,000. Administrative, marketing, turnover, landscaping, trash, and contract services, another $180,000. That puts total operating expenses around $1.2 million. Net operating income is about $1 million. So far, the building looks solid. Then debt enters the picture. If the owner financed the acquisition with a large loan at a higher interest rate than expected a few years earlier, annual debt service might consume $700,000 or more. Suddenly, pre-tax cash flow is only around $300,000 before major capital expenditure reserves. Set aside $150,000 for longer-term capital items, and the actual distributable cash may be closer to $150,000. That means a property producing more than $2 million of annual revenue can still leave the owner with a surprisingly thin cushion. And this is not a worst-case scenario. It is the point of the model. Apartment buildings often feel rich at the top line and ordinary at the bottom line. Change one variable and the stress appears fast. Let occupancy slip from 95% to 89% during a wave of new supply in the neighborhood. Offer concessions to attract tenants. Assume effective revenue falls by $180,000. At the same time, insurance renews sharply, higher taxes increase after reassessment, and one plumbing issue adds another $70,000 in unexpected cost. NOI drops from roughly $1 million to perhaps $700,000 or less. If annual debt service is still $700,000, the owner has effectively lost the cushion. One more surprise, and cash flow turns negative. The same structure that magnifies profit also magnifies pain. That is why apartment buildings can move from apparently safe to financially awkward without ever becoming visibly empty or abandoned. The failure case makes this even clearer. A good example is the broader collapse of highly leveraged multifamily syndication strategies when interest rates reset and operating assumptions proved too optimistic. One of the most public cases came from the rise and fall of large Sunbelt apartment investors that bought aggressively during the low-rate boom, financed with floating-rate debt, and projected continued rent growth strong enough to outrun higher costs. The assumptions looked reasonable in the moment. Rents had been rising fast in many markets. Capital was abundant. Bridge debt allowed buyers to close quickly, plan renovations, and promise investors that future rent increases would drive strong returns. Then, the environment changed. Interest rates rose sharply. Insurance costs increased. Construction and maintenance became more expensive. In some high-growth markets, a new wave of supply hit. At the same time, rent growth cooled. Deals that had been underwritten around cheap debt and fast rent gains found themselves squeezed by exactly the opposite conditions. The trouble with floating-rate debt is that it can act like invisible leverage. The principal balance may not change much at first, but the cost of carrying it does. If a property was acquired at a very low cap rate on the assumption that rents would rise and refinancing would remain easy, higher debt service can erase the margin quickly. Once cash flow falls, distributions to equity investors stop. If reserves are thin, capital calls follow. And if the exit value is lower because cap rates have expanded, even a sale may not rescue the equity. This pattern showed up repeatedly across the post-2022 apartment market, especially among sponsors that relied on short-term, floating-rate loans. aggressive pro forma rent growth, and limited room for error. Some assets were recapitalized, some were sold at disappointing values, some moved toward default or distressed restructuring. The lesson was not that apartment demand disappeared. It was that good demand does not protect a fragile capital structure. There is an older and broader version of the same lesson in many real estate cycles. In the savings and loan era during the early 1990s, property downturn in the 2008 financial crisis, and again during the rapid rate shock after 2022, owners who entered with too much leverage or unrealistic exit assumptions discovered the same truth. Real estate rarely fails because walls stop standing. It fails because the cash flow, the debt, and the timetable stop matching. Now consider the success case. Apartment ownership can work extremely well, and one reason is that housing demand is persistent. A useful operator to study is Equity Residential, one of the most established multifamily REITs in the United States. The company built a strategy around scale, professional management, high-quality portfolios in supply-constrained urban markets, and disciplined capital allocation. That does not mean every year is easy. It means the structure is stronger. Scale changes the economics. A large operator can negotiate better service contracts, spread technology and management systems across many properties, and access debt and equity capital more efficiently than a small owner. Geographic concentration in strong markets can help occupancy and rent growth, though it can also introduce local risk. Professional revenue management improves pricing. Preventive maintenance tends to reduce chaos. A public REIT also has more ways to raise capital, recycle assets, and manage leverage compared with a small owner who depends on one bank and one building. The key point is not that big always wins. It is that strong apartment performance often comes from a combination of location quality, balance sheet discipline, operating consistency, and capital access. The tide under the boat matters. When urban incomes are strong, housing supply is constrained and financing is available on reasonable terms. High-quality operators can compound value for years. They are not succeeding because apartments are magically passive. They are succeeding because they are better at running the machine. Another success pattern appears in value-add investing when it is done carefully. An owner buys an undermanaged property in a neighborhood with durable demand, upgrades units gradually improves common areas, tightens expense control, and raises rents in line with genuine quality improvements. The upside comes not from fantasy numbers, but from operational execution. When the purchase basis is sensible and leverage is moderate, that strategy can create real value. When the buyer overpays and assumes impossible rent jumps, it becomes speculation disguised as renovation. At this point, the building should be redefined clearly. You are not simply owning apartments. You are owning a housing service business financed by debt, constrained by regulation, exposed to local competition, and constantly negotiating between current cash flow and future capital needs. That is why the one-year owner model matters so much. Take that same 100-unit property in a normal year. Effective total revenue, $2.2 million. Operating expenses, $1.2 million. NOI, $1 million. Debt service, $700,000. Capital reserve, $150,000. Pre-tax cash left to ownership, roughly $150,000. If the equity invested was $4 million, that is only a modest cash-on-cash return in the current year, even though the building itself may be worth perhaps $16 to $20 million, depending on the market and cap rate. This is where many new investors get confused. A valuable building is not the same thing as a high cash-yielding building. A great deal of the wealth case often depends on loan amortization, rent growth over time, and future resale value. Now stress the year. Lower occupancy and concessions reduce revenue by $180,000. Insurance rises by $40,000. Taxes rise by $30,000. Unexpected repairs add $70,000. NOI falls from $1 million to about $680,000. Debt service remains $700,000. Capital needs do not vanish. The owner is now effectively feeding the building rather than taking money out of it. Nothing dramatic had to happen. No fire, no scandal, no total collapse in housing demand. Just a few ordinary forms of pressure arriving together. That is the structural trap in apartment ownership. The business looks defensive because people need shelter. The capital structure can still be fragile. Future pressure adds another layer. Apartment owners now operate in a world shaped by higher interest rate sensitivity, insurance repricing, climate exposure, stricter building standards in some jurisdictions, and political pressure over housing affordability. In many markets, supply growth can temporarily soften rents, even while long-term housing shortages remain real. Technology also changes operations through smart locks, centralized leasing, pricing software, and maintenance systems. But technology does not repeal the laws of debt service or roofing costs. One especially important structural shift is the relationship between interest rates and value. During low-rate years, investors often accepted lower cap rates because safer income looked scarce and financing was cheap. When rates rise, buyers typically demand higher returns. That pushes values lower unless NOI grows enough to offset the shift. An apartment owner may therefore experience a strange outcome. The property can remain operationally decent while its market value declines because the capital markets changed. This is one reason sophisticated investors still buy apartment buildings even when current cash flow is not spectacular. They may be underwriting long-term inflation protection, land scarcity, redevelopment, potential population growth, or future operational improvement. Some are buying a bond-like income stream. Others are buying embedded upside in the dirt underneath the building. In major cities, the land can eventually matter almost as much as the current rent roll. That, however, is not a free pass. It is a reminder that the visible rental business and the invisible capital markets business are intertwined. There is also the human side. Apartment ownership is not just spreadsheets and cap rates. Every number in the rent roll is a household. Maintenance delays affect real lives. Aggressive rent strategy can collide with politics and community backlash. Evictions are economically important and socially sensitive. A building with poor service quality may lose tenants even in a strong market. Reputation matters more than some investors assume. So does professionalism. Well-run buildings usually share a few traits. They budget conservatively. They respect reserves. They monitor turnover costs carefully. They keep maintenance from becoming deferred disaster. They understand local regulation before making promises to investors. They avoid assuming that every renovation instantly justifies a giant rent increase. Most important, they know the difference between yield created by operations and yield manufactured by leverage. That difference separates durable owners from temporary promoters. None of this means an apartment building is automatically a good or bad investment. The outcome depends on location, purchase price, financing terms, regulation, management, quality, supply conditions, and timing. Numbers move, insurance markets change, tax policy changes, interest rates change. This is an explanation of the machine, not advice to buy one. So what are you really buying when you buy an apartment building? At first glance, it looks like a collection of doors, kitchens, hallways, and monthly rent checks. It seems like a simple cash machine backed by an essential human need. But the longer you own it, the more the deeper structure reveals itself. The real business is a flow of housing income balanced against debt, expenses, regulation, and relentless physical upkeep. Its returns can be steady, but they are rarely effortless. Its risks are quieter than a tech startup's, yet often more persistent. A full building can still disappoint. A mediocre year can still damage value. And a property that looks boring from the street can become a powerful long-term asset in the hands of an owner who understands financing, reserves, operations, and patience. You thought you were buying an apartment building. What you were really buying was a leveraged housing income system that only works when rent costs capital and time remain in balance.